Is the mining sector headed for a stock market crash? Well, that's what we'll be discussing, along with the outlook on several different commodities with John Feneck, president of Feneck Consulting. John has spent several years working in the past at JP Morgan, BlackRock, and finally at Sprott, selling commodities products to various investors within the space. John, it's a pleasure to have you on Kitco.
Thanks so much, David. Pleasure to be here.
So like I mentioned, before you started your own consulting firm, you have spent several years, several decades actually, of your career working at top institutional investment firms, selling commodities products. We're going to be talking about your experience and some of the sentiment in the space currently and the lessons you've learned in the past and how you're applying them today. But first, let's talk about the gold mining sector as a whole. The GDXJ, can we pull up a GDXJ? This is the Feneck Junior Gold Mining Index. It's had a nice run up last year and then it's fallen down. You're telling me offline that we're posed for a potential market correction and that several people you've talked to in this industry are getting a little worried. Why are they getting worried, John?
Well, as you can see from this chart, David, this is a 5-year run on GDXJ, and the high of 2016 was 52.50 a share. You can see from this chart we're at 46 and change right now, and that means after 5 years you've made absolutely no money, and that's not acceptable in this market, right? Because the broad market is up significantly over the last 5 years. And this is one of the reasons to address what you were saying earlier, that financial advisors, hedge funds, private equity, the kind of people that I've associated with throughout my career have sort of avoided the space because they see this kind of a chart and say, that's not very interesting, right? But our performance at Feneck Consulting has been way better than this because we're active managers. So I've been very vocal throughout my career here, taking a stance against many newsletter writers, in fact, that buy and hold simply doesn't work in junior mining. You've got to be on top of it. You've got to do the homework. You've got to talk to CEOs, and it's very labor intensive, right? So I've talked to 22 CEOs this week alone. And to your point, the sentiment is not good right now because junior miners continually have to raise capital. It's a fact. And they're doing that at bargain basement prices. So we're looking at that as, a real disconnect here between the price of, say, a junior mining stock and the price of gold. Gold is held in quite well here, over 1,800 an ounce as we speak. And that is not being felt by a lot of the CEOs I talk to in the gold junior mining space. So I think it's just one of those times, as I've said recently, that you have to hold your nose and buy and really do the homework to make sure that your entry points are decent. Go ahead, David.
Oh, I was just going to say, you're right. The gold price has been holding steady around $1,800. But if you go back to that chart, GDXJ, it does look like there's a very close correlation between the gold miners index and, well, at least the juniors and the gold price. It's just we've had a bit of a rally up until the last month, and then it's fallen down a bit. It just looks like the move here for the GDXJ is a little more accentuated because of the higher beta. So yeah, gold's moved down a little bit, but not as much. The juniors are just a little more sensitive, I would say.
Yeah, the beta on GDXJ is not low. This is a high beta product, as you can see from the low there of $22 and the high of $61 just within a less than a year period, right? There's a lot of torque in this. So, there's a lot of upside in something like this, but you have to be able to sell. And that's one of the things that we teach our investors about: trimming gains, not getting greedy, and knowing when to fold them, so to speak, because you can see right here, 5 years holding and buying and crossing your fingers is not a strategy.
Do you think this downturn we've seen in the GDXJ was solely caused by the downturn in the gold price? In other words, suppose gold would recover to $2,000. Can we potentially see a disconnect between the gold price and the gold miners index, where the gold price rises back up, but the gold miners continue to fall, perhaps even further from current levels? Is that possible?
It's possible, but I don't think likely. There's a great piece that my former firm Sprott put out this week by John Hathaway, and he referenced Paul Wong, one of my former teammates, who put out some great data about the disconnect we're seeing right now in junior and senior miners relative to history, right? So we're seeing very good valuations. We're seeing low net to debt EBITDA. We're seeing good free cash flow. We're seeing a lot of positive things. it's just not reflected in prices yet. So we've been encouraging clients to trim where they need to, but really, not abandon the space. That's very important.
Mm-hmm. Okay, well, like you said, you've had to deal with clients who potentially were not potentially, but let's put it this way: they weren't the biggest fans of the PM space. And let's role play. Let's do some role playing here. Imagine if this were an investor lunch. Now we're a potential investor, and I'm saying to you, John, well, look, gold has not performed very well in the last several months. We've had a bit of a run up last year, and that's it. And it's come back down. It's wiped out almost all its gains, not quite. The junior minor index is down, 30% since the highs, the GDXJ itself. Why should I be interested in this space right now when the equities are still climbing to all-time highs? What's the play here?
So I would say to that person, what are you doing to hedge in your portfolio? How are you creating any type of protection in your portfolio when you're fully exposed to technology and hydrogen and all these things that are super hot right now, right? That's the client that comes to us a lot of times, that will come to us with momentum money. And we're not interested in working with those people because we're value investors, right? We're looking for value or deep value in everything that we do. So I'm never going to chase a mining stock. I'm never going to chase a tech stock. I'm not a chaser, right? I'm very patient. I sit out there with stink bids all day long, and I just wait for things to come to me. Now, occasionally, if I'm, if I think there's a news item that's upcoming on a stock that they've telegraphed publicly, then I'll hit the ask, no problem. But we're going to be very patient versus the average portfolio management group that you're going to talk to. So my answer really is along those lines, David. But also, gold and silver are completely underowned by investors as well as portfolio managers and the financial advisor community. I mean, it's a fraction of what it was at the peak in 2011, right? So if we even return back to that level, we're going to see prices like last summer in the miners, but even better. And I think that's going to be predicated by a market sell-off, right? So we look at things like the IWM, which is the ETF for the Russell 2000, and it's starting to show some weakness here over the last 2 weeks. It's not crashing by any stretch of the imagination, but that has let us down in previous corrections. If you look at September of 18, Russell 2000 let us down. If you look at February of 2020, same thing. So we watch that as a barometer for how is the small cap market doing, because these things are very illiquid, and when they start to sell off, it can cause a lot of other problems. Okay.
All right. So to answer your question, what am I doing right now to hedge? So continuing on this role playing example, well, I'm in cash right now. Got a little bit of crypto on the side too, the bigger ones, Bitcoin, Ethereum. That's what I'm doing to hedge. So are you telling me I should be going into gold to hedge too? And if so, how much gold should I be buying? First of all, why is gold a good hedge? Hedge against what exactly?
So it's, as Rick Rule taught me and has said on your show and other shows, it's portfolio insurance, right? So if, wealthy people need to insure their portfolios, and they do that through ownership in something like gold or silver. Bitcoin, Ethereum, other things like that, we have a zero position there because, they're unregulated markets, right? I'd be much more interested in looking at crypto when it becomes regulated, which I know is not a popular opinion, but we had dinners with some very intelligent people on roadshows in May of this year at 65,000 or 60,000 Bitcoin, who were saying this is an all-in moment, and then it went to 30,000 or 35,000, right? So it's you can lose half of your value in a month or two. Not interested, right? So I feel like we've missed some of that upside in crypto, but that is not a hedge. A traditional hedge going back thousands of years is precious metals, and that is gold and silver and related. So,
if you're referring to a hedge against, are you referring to a hedge against equity volatility? Because remember back last year when we had the correction in March, gold went down initially as well. Gold miners got hit especially hard, while gold miners were stocks as well. So how is it that it can be used as a hedge instrument if they move in the same direction downward during a very large correction?
Right. So that correction, I think, is needs to have an asterisk next to it, in the sense that everything went down at once. That was a liquidity event, as we say. So gold, silver, the miners, they all got taken down at once. as chartists, as technicians, we don't look at that as like, oh my gosh, everything's broken. Like look at every chart. I mean, look at retail stocks, look at tech stocks, everything went down in tandem, right? It was just a very fast V-shaped recovery. So we think that this time around, gold and silver and related have proven themselves since the March 2020 correction to where we're not going to get that same type of magnitude of a sell-off. Again, we would make what we call a higher low. So I'm not saying you wouldn't see a knee-jerk reaction down to certain retracement levels, but I think the recovery would be very fast, and we would, encourage people to get fully invested if you get another buying opportunity, anything close to like last March or of 2020.
All right, fair enough. So I'm a high net worth individual. I've got about $1 million in my portfolio. How much of that million should be in gold as a hedge?
I'd say 5 to 10% in the physical metal.
Okay. And what other instruments could I buy besides the physical? Let's say I don't want to go to a bank or a bullion dealer and buy physical, and I don't want to deal with storage costs. What else can I do?
So when we worked at Sprott, I mean, PSLV is a physical silver product that we marketed, as well as PHYS, which is a physical gold product. They, have a better backing, for investors that want, to buy something and not buy the direct bullion, because they can offer physical delivery of that. Now, again, physical delivery of any metal requires a lot of money, a lot of headache, and it's not for everyone. So, we think that you should own some of that through products like PSLV or PHYS, but then complement your positions with mining stocks, because you're going to get absolutely good leverage to those underlying metals when we have a rally by owning the mining stocks.
Okay. So again, me as a skeptical investor, not used to the space, shall we say, in this example, what's your outlook for the metal sector now? We've had a nice run up last year. Then again, we've fallen. Are you expecting more of a correction? What's the play going forward, John?
Sure. So I think June 16th was a very destructive day for metals and mining, more so for the miners, because the Fed really came out and was perceived to be quite hawkish. We take the other side of that trade and say that, this is just jawboning by the Fed here. Yellen did some more of that this week. What's interesting is that, Powell kind of backpedaled a little bit and then, testified this week. And in his testimony was not hawkish in my view at all. I think it's quite dovish. In fact, we're just not seeing follow through in terms of buying because it's the summer doldrums and, volumes are quite low. So we use these opportunities, these disconnects, as buying opportunities. And we're not saying go all in here. We're saying dollar cost average. So if you bought stuff higher, you still have conviction in it, buy some more, just don't buy a ton. You want to have more conviction when you go heavier into the sector. And by that, we mean August 26th and 28th through the 28th is when Powell and company will meet in Jackson Hole, Wyoming. We think that meeting is going to be very relevant. And you heard that after the Fed minutes on CNBC recently, 2 of the 3 guests were saying exactly the same thing. So they're waiting for confirmation from the Fed that things are going to be A-OK going forward. And that's why we're building positions in anticipation of that, David, going forward, because the broad market is selling off a little bit here, and that's healthy going into August. Because if we were to ride high going into that meeting, right, real estate's cranking, the Nasdaq's cranking, I'd be more worried about the Fed getting hawkish just to cool things down. Now, if we go in, kind of after a little bit of a respite here, in a breather, I think it's very constructive, and the Fed's just going to play ball. Look what happened with China last week. They're cutting rates. So we think that that's very positive going forward.
Perfect. Okay, so just to sum up here, we're still waiting for signals for a market move. Until then, you're waiting for Jackson Hole. Let me ask you this question, just to rephrase more simply. The GDXJ, the gold market, has crashed, I would say, over the last couple of months. Is this crash over?
I think GDXJ will hold that major support level, which is $40 to $41 a share. Right. Okay. So I think that we're good there. And this is barring another, pandemic related thing that I can't foresee, right? Because that would take all bets off the table. But I think that we're out of the woods. I think that 40 to 41 will hold on GDXJ, and I think the 29.50 to 30 level on GDX will hold. So, we're still invested in both. We just, have smaller positions in those, and we choose to buy some names, where we have more conviction by talking to those CEOs and getting a feel for, what's happening under the hood.
Okay. All right. And John, tell us about some stocks within your portfolio that you do like, that have done very well for you.
Sure.
You don't have to go through all of them, just maybe your top one or two.
Our top silver holding is Golden Minerals, which is AUMN. We think that there's tremendous value here at 53 cents. There was a newsletter writer out there at 71 cents here recently who had sold his entire position, caused a lot of vol in the product, volatility, had never even talked to the CEO once. And those are the kind of, really, I'll be careful on what I say here, but I think that, it's not very prudent to be doing that and having thousands of people follow you if you don't take 5 minutes and actually talk to the company and I get an idea of what's actually happening, right? So Rodeo is in production. Velardania is close by. They're going to share a mill. If you look at the analyst reports, which I would think are way more relevant than our newsletter writers, feelings about something. The analysts that just came out this week are at $1.10 and $1 a share US. Stocks at 53 cents. That would be HC Wainwright and AGP. Another one that we like in gold is USAU. That's called US Gold. All four of their projects are in the US. I just visited the Copper King mine in Wyoming last month, did a tour. I think they have a tremendous amount of aggregate that the market doesn't even aware of that could help fund a lot of their operations going forward. And there's going to be probably some news flow around that in the coming weeks. But it's a NASDAQ listed stock with 7 million shares outstanding, and I can account for where 4 million of those shares are. So when you have a float of roughly 3 million shares, very tightly held. A couple other names in palladium, we like DCNNF, which is Canadian Palladium. Wayne Tisdale, the CEO there, was responsible for the Rainy River build out, which is now New Gold's top mine. It's trading at 9.5 cents US. I think it's got tremendous value. If you look at the May news, there are very good drill results that have been kind of blown off here, and they're in a great jurisdiction. Another name in silver that we like is Fabled, FBSGF. Fabled is right now, if you buy Fabled up until mid-August roughly, for every 5 shares you buy of that stock, you're going to get 1 share of Fabled copper. If the spinoff is approved. And so we've been loading up on that stock because we believe in copper as well, right? So Peter Hawley there has been there 35 years in mining, very good geo background. And we like that stock here at 10.5 cents.
Perfect. And other metals that you do like, John, besides gold?
We like silver to some extent. I mean, we like copper. We're playing copper through Copper Juniors, like Copper Bank and a few other names that we own. We think there's tremendous value there. If you look at the COPX, which is the large cap copper plays, David, it's done extremely well. But the juniors have not necessarily followed suit, yet copper has broken through all resistance levels. So when I'm talking to people at the exchanges, there seems to be a shortage of copper out there. And there's no shortage of building, right? And there's no shortage of industrial demand. I think that copper is going to do extremely well this year into next year.
Okay. And finally, you mentioned that you are an active fund picker, or active stock picker rather. So how has your fund performed so far this year?
Yeah. So through June 30, we're up just under 15%.
Wow.
That is on our website under the performance tab. So, last year we were up 87%, and we were able to post our 5-year number in January of this year, which we're very proud of. So we're top decile ranked through 5 years, all time periods, 1, 3, and 5 years ended June 30th.
Mm-hmm. And the 15% is from year to date?
Yeah, year to date we're up 15%. I think the GDXJ is down about 14, so we're about 29% ahead of GDXJ. Yeah.
Actually, I think it's down more than that. It's like the GDXJ is It's at 44 bucks today, and the high was 60. Oh, but that was last year. Right? So yeah, it's down to like 30% since the high last year. Yeah. Well, fantastic outperformance. John, I want to thank you so much for your time today, and I look forward to catching up with you next time. We'll delve deeper into your strategies. Thank you.
Thank you, David.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.